Good day, viewers. Welcome to our Q2 Global Listed Property Dashboard. I'm Binette van Wyk, COO at Catalyst Fund Managers, and this morning I'm joined by Gugu Langiza, an investment analyst of our Global Listed Property long-only portfolios. Books, it's been a tough time for property, hey? The last 2.5 years, we've seen capital markets really driving the narrative, but I get the impression that the tide is turning in our favor. But before we do a deep dive into that topic, I think let's start off with painting quite a simple picture. Because we often hear this comment that global listed real estate is a levered asset class and that a cut in interest rates will be a strong catalyst for performance for the sector. Can you maybe start off by unpacking that statement for us?
Thank you for having me, Bennett. In the broader real estate industry, which includes the public and the private markets, we have what we call real estate investment trusts, commonly referred to as REITs. So now, REITs are by regulation required to distribute quite a substantial portion of their earnings to shareholders in the form of dividends. This places them in a position where they have to rely quite heavily on capital markets, which includes debt capital and equity capital, to drive growth via acquisition of existing assets and development of new properties. And this inherently makes it very important for them to have access to capital markets, and most importantly, access to cost-effective capital, which is why interest rate cuts are broadly expected to be a tailwind for REITs.
Gooks, let's focus on the correlation metrics for a moment. So if we start off focusing on SA listed property, we know that there's quite a high correlation between SA listed real estate and local bonds. But if we switch to global listed real estate and we look at the long-term correlation, we see that actually global listed real estate is a lot more highly correlated to global equities than it is to global bonds. Maybe you can unpack that for us, but also focus on what we've been seeing in the short term.
Sure. So historically, global real estate has had a low correlation with global bonds and a moderate correlation with global equities. So to put it in perspective, over the past 25 years, global real estate has had a 0.75 correlation with global equities and approximately 0.4 correlation with global bonds. So now this demonstrates the diversification benefit that comes with including global real estate in an investment portfolio. Now, as you rightly pointed out, Bennett, cross-asset correlations are not static. As we've seen in recent times, interest rates have been one of the most dominant macroeconomic drivers of returns across multiple asset classes, most so than operating fundamentals in the case of real estate. As a result, we've seen a bit more heightened correlation between global real estate and global bonds over the past few years.
Cooks, interest rates have really been driving the bus, right? It's been tricky for us to navigate as well as for our market participants, but even so for the leaders of the central banks globally. We saw the ECB, or the European Central Bank, being first movers in this space with their recent 25 basis point cut. But then on the other hand, you see the Fed being quite challenged, regarding, is the rate cut going to come? What is the size of the cut going to be? So it's really been tricky, but let's just park interest rates and the potential cutting to the side. I think regardless of that, we need to look at the operating fundamentals of the sectors that we invest in. So when you and the team look at the operating performance of the sectors or the organic growth of these sectors, what are the key drivers that you look at?
Sure. I think a key measure of operating performance or organic growth is what's referred to as same property net operating income, or commonly referred to as same property NOI. So same property NOI is the difference between the total rental revenues generated by the underlying income producing properties versus the total property level operating expenses. Now, if you zoom in on that very simple formula, you look at the notable drivers of rental revenues, That will typically include, the embedded mark-to-market opportunity within the rent roll. That is, how different are the passing in-place rents to the market rental rates. And then secondary to that, you have market rental growth, which is inextricably tied to supply-demand dynamics. And then over and above that, Bennett, you have, annual or periodic rental bumps or escalators, and then you have, gains in occupancy or reduction in vacancy rates as, one of, the dominant drivers of rental revenue growth. And that is before we even account for growth that is driven by external growth initiatives, which will include, acquisitions, redevelopment of existing properties, or the development of new properties.
Gooks, it's actually such a beautiful formula. Hey, you need good supply and demand dynamics, which leads into strong market rental growth. That then drives your top line, your rental revenue growth, which then at the end of the day hopefully feeds into your same property NOI or net operating income. Maybe let's go into a deep dive into some sectors. Maybe you can showcase some sectors where we've got strong supply and demand dynamics, and then ones where it's not looking so good.
Sure. I think the sectors that stand out in terms of having, favorable supply-demand dynamics are mostly U.S. property sectors, and these include strip centers, single-family housing, manufactured housing, data centers, and senior housing. Now, if you perhaps take U.S. strip centers as an example, right, the sector is projected to have considerably subdued supply growth over the next several years, and that is largely underpinned by prohibitively elevated construction costs, as well as the challenging cost of capital background. Now, to put it into perspective, Bennett, in some markets, rental rates would need to increase by about 35% to as high as 65% for new development to make economic sense. And that has proven to be quite a favorable tailwind for existing landlords that own above average quality assets in markets with very strong demographic attributes. Now, to give you a balanced view, there are sectors that are facing a less favorable supply-demand dynamic, notably U.S. apartments, particularly in Sunbelt markets, as well as U.S. industrial property. Now, despite that, the U.S. industrial property sector still boasts, one of the above average same property NOI growth over the next several years, and that is largely supported by a very healthy mark-to-market upside, which in some instances can be as high as 40 to 50%.
Googs, you had the opportunity, you and some of the team members, to attend the NAREIT REIT Week conference now recently in June. It's always a great opportunity for you and our team to engage with, the REIT companies and the real estate companies that we invest in. It's always been a part of our process, right? To engage with management, to ask the tougher questions, have a robust debate every now and again. What were some of your key takeaways from this conference?
I think we were encouraged by, the fact that operating fundamentals remain largely in check. And most importantly, supply, growth outlook remains broadly in check on account of, the restrictively high construction costs that, we've observed over the past couple of years across, the global real estate landscape, as well as just the challenging cost of capital background. I think the consensus among investors and market participants was that real estate as a sector is quite undervalued relative to other asset classes. And broadly, the expectation is that interest rate cuts will serve as, a catalyst for the sector to outperform. And to that point, historically, real estate has outperformed general equities subsequent to an interest rate hiking cycle.
We've got that beautiful graph, hey, Googs. Viewers, you must ask us for that graph if you're interested. Googs, so last but not least, what is your outlook for the sector?
I think in response to that question, Bernat, I would hark back to your earlier comment about, interest rate cuts and timing thereof being highly uncertain and very difficult to determine, as we've seen with, central bankers all over the world. But what we find encouraging is that, the sectors that are enjoying robust operating fundamentals have quite healthy organic growth expectations over the next several years. As such, we see the sector broadly as attractively priced, and we see the sector delivering a forward funds available for distribution yield of about 5%, coupled with a 4-year compound annual growth rate of about 5.6%.
Brooks, thank you for your time and for sharing your valuable insights with us today. Viewers, I think it's a very attractive entry point for global listed real estate. As Gugu alluded to, you're sitting with a strong yield, strong growth, and we haven't even touched on, interest rate cuts. But watch this space. If you'd like to learn more, please refer to our full Q2 global dashboard, or alternatively, please reach out to me as per the contact details below. Thank you and goodbye.